America is now carrying roughly $36 trillion in national debt, a figure so large that it barely feels real, yet it still represents obligations owed to real creditors. China is often singled out as the primary lender, holding close to $750 billion in US debt. But this framing misses a crucial detail. China itself is deeply indebted, with liabilities exceeding $18 trillion. Much of China's debt is held domestically, primarily by its own banking system. But those same banks also hold American debt. Meanwhile, US banks own Chinese debt, European debt, and obligations from nearly every major economy. The deeper one looks, the more entangled the system becomes. Every country borrows. Every country lends. And collectively, the world now carries over $300 trillion in debt, roughly 3 times the size of global annual output. If the entire world is this indebted, a simple question naturally arises: who is the money owed to? The answer is far more complex than it appears, and it reveals something fundamental about how the modern financial system operates. Global debt is not merely an accounting anomaly, it is the mechanism that keeps the global economy in motion. Debt itself is far from a modern invention. Long before banks, coins, or paper currency, debt existed as a social agreement. Communities relied on trust-based lending, grain lent in spring and repaid after harvest, often with a surplus. At its core, debt has always been about solving present needs with future resources. As societies grew more complex, debt scaled with them. Monarchs needed to finance wars, fortifications, and fleets, expenses far beyond what a single lender could provide. In the 17th century, England pioneered a solution by issuing public debt in the form of bonds. Citizens exchanged cash for written promises of repayment with interest. This innovation transformed state finance, allowing governments to raise massive sums without immediate taxation. By the 20th century, debt had gone global. 2 world wars forced unprecedented borrowing, not only to fund combat but to rebuild entire nations. In 1944, the Bretton Woods system anchored global currencies to the US dollar, itself linked to gold. But economic growth quickly outpaced gold reserves. In 1971, the United States abandoned the gold standard, turning modern money into fiat currency, backed solely by state authority. This shift unlocked the era of large-scale borrowing. From the 1980s onward, governments discovered that debt was not just a wartime tool, it was a growth strategy. Borrowing funded infrastructure, stabilized recessions, and sustained economic expansion. Over time, debt ceased to be exceptional and became routine. Today, debt underpins nearly every aspect of modern governance. It finances public services, absorbs economic shocks, and sustains political promises. The result is a global debt stockpile exceeding $300 trillion. To visualize its scale, $1 million stacked would reach the height of a building, $1 billion would touch the edge of space. 300 trillion would stretch to the moon and back dozens of times. Yet this immense figure does not represent a single creditor. Modern debt circulates in loops, not straight lines. In the United States, roughly 70% of government debt is held domestically. The government borrows largely from its own population through financial institutions. Banks, pension funds, insurers, and investment firms channel idle savings into government bonds, attracted by their safety and predictable returns. US banks alone hold nearly $1.8 trillion in treasury bonds. Pension funds allocate significant portions of their portfolios to bonds, as do insurance companies seeking stability. When the government pays interest, that money flows back to these institutions, increasing their available capital, much of which is reinvested into more bonds. The result is a self-reinforcing cycle of lending, repayment, and reinvestment. This pattern extends globally. About 30% of US debt is held abroad, purchased by foreign governments and institutions following the same logic. Japanese savings finance. European bonds, European capital flows into emerging markets, and surplus funds eventually circle back into US debt. Global debt is not a ticking time bomb, it is a continuously rotating system. Governments rarely eliminate debt outright. Instead, they refinance old obligations with new borrowing. While this may appear reckless, it is now fundamental to economic stability. Growth itself depends on debt. Government spending injects money into the economy, sustaining employment, consumption, and investment. Removing that spending would reverse the cycle. Historical examples illustrate the danger. When Greece lost access to bond markets during the 2008 crisis, austerity followed. Public employment collapsed, wages fell sharply, and the economy shrank by a quarter. Politicians everywhere learned the lesson: halting borrowing can trigger economic freefall. Debt also becomes essential during crises. In 2020, governments worldwide borrowed at historic levels to prevent economic collapse. The United States alone borrowed nearly $4 trillion in 1 year. It was not ideological, it was survival. Yet debt carries long-term risks. As borrowing grows, interest payments consume a larger share of government budgets, limiting future investment. High debt ratios have become normalized, but stability depends on continued confidence. If lenders lose faith, borrowing costs rise sharply. Some governments respond by expanding the money supply, but this risks inflation. In extreme cases, such as Venezuela, excessive money creation destroyed currency value and wiped out personal savings. Even moderate inflation erodes purchasing power and destabilizes economies, especially in countries borrowing in foreign currencies. When confidence collapses entirely, governments face default. Unlike households, states cannot easily recover from this. Credit dries up, investment disappears, and economic contraction deepens. Debt-fueled systems rely on trust, and once broken, rebuilding it is exceptionally difficult. As debt vulnerabilities grow, investors increasingly seek alternatives perceived as stable. Capital has flowed into assets like gold, which historically functions as a hedge against currency risk and systemic uncertainty. These shifts reflect growing concern about the long-term sustainability of debt-driven growth. Ultimately, modern economies are built on debt not as a flaw, but as a design. Borrowing enables growth, stability, and crisis management, but it also creates fragility. The global system persists because it must, not because it is risk-free. And the deeper the reliance on debt becomes, the more difficult it is to imagine an exit without consequences.